Hey everyone, what's up and welcome to Front Run, where we predict the future of money and technology. Thank you to all of the new listeners, subscribers, and followers. If this is your first time with us, we are all here to front run the next generation of wealth creation that we believe is decentralized finance and crypto. It's been a great past couple of weeks within the broader crypto ecosystem, lots of upward movement. I'm your host, John Cook. It's the fifth week of January 2023, and we are going to answer a very important question for those following the DCG, Genesis, Gemini, and Grayscale just catastrophe that's unfolding. We're going to answer this question. Is Grayscale intentionally delaying its Bitcoin and Ethereum ETF conversion? There is a ton to unpack, and I wrote quite a bit about it on frontruncrypto.com. So for those who want the extra detail, the references, the overall analysis and thought that went into forming this point of view that we're about to cover today, I encourage everyone to go to frontruncrypto.com and check out the article titled Grayscale Misconduct and Conflicts of Interest with Digital Currency Group. This is also posted in the show notes for everyone to review, which again I highly encourage because reading is a great way to retain knowledge and information. So, quite a few bullet points within this question that we need to explore. Specifically, we're going to better understand the DC Genesis meltdown with Gemini in relation to Grayscale. We actually covered this in part one, but I'm going to do a speed run of it very quickly. We're going to outline and review the two separate legal proceedings against Grayscale's Bitcoin and Ethereum trust by two different investor groups at the same time. It's quite impressive. We'll review Grayscale's claims of misconduct and conflicts of interest within Digital Currency Group by these two separate investor organizations, as well as allegations of failure to act in the best interest of Grayscale's trust stockholders, against the overarching theme that Grayscale's ETF campaign is essentially a wasteful campaign destined to drag out in the courts for years. I'm paraphrasing some of the legal proceedings, and an elaborate marketing expense to lure retail investors into the trust with no way out. Those are the topics that we're going to explore. Again, the question is Grayscale intentionally slow walking the ETF conversion for its Bitcoin and Ethereum trust? And I think if anyone has any exposure to the Grayscale ecosystem, you're going to want to actually read the analysis and form your own point of view. If you have exposure to DCG via probably Gemini, you're going to want to listen because it's really Gemini was one of the sources of collateral that was able to facilitate all of the uncertainty we're about to review. So let's dive into it. Recall that on January 15th, we actually published part one of Untangling Digital Currency Group, where we tried to explore the relationship between Gemini and the DCG subsidiaries Genesis and Grayscale. What I found like super interesting is that we wrote that on January 15th, and then 5 days later, Genesis Capital petitioned for bankruptcy. Specifically, Genesis is actually a composition of multiple subsidiaries. So when you say Genesis is filing for bankruptcy, when we go to dcgupdate.com, showing this to people watching on the YouTube, what's actually happening, again from part one, Genesis is the Genesis organizational structure. It's a composition of Genesis Trading, right? Genesis Parent Firm and Genesis Lending. Genesis Lending, which is called Genesis Capital, is a composition of Genesis Global Holdco, Genesis Global Capital, and Genesis Asia Pacific Ltd. All of these firms collectively filed bankruptcy on January. They petitioned for bankruptcy on January 20th under the collective umbrella of Genesis Capital. This happened 5 days after we published part one. So originally this was supposed to be a two-part series where we like uncovered DCG and did this expose, but we're actually gonna expand it out into three parts, because we need to dive into like the claims of accounting irregularities and potential fraud associated with Genesis. And we have to actually do an assessment of the complex legal structure within the DCG ecosystem that made all of this insanity possible. That is going to be part three. Right, part one we covered Genesis and Gemini, just like the interrelationship with the merry-go-round of 3AC. Part two, which is what we're talking about now, we're going to review claims of Grayscale's malfeasance, intentional deception, and then the overall set of conflicts of interest between Grayscale's parent organization, DCG, and the independent entity that is the Grayscale Trust. But in order for all of this to make sense, just very, very brief speed run. I've loaded this up on the screen for those who are watching. Remember from part one, Genesis is a lending desk that loaned Bitcoin and later Ethereum to 3AC. Okay. The collateral that was provided to facilitate the loans to 3AC was the shares of the Grayscale and Ethereum trust, right? So if you look at this loop, once money gets into the Genesis ecosystem, Genesis issues that loan to institutional investors, hedge funds like 3AC, but the money has to be collateralized by something, right? In this case, 3AC had existing shares of GBTC at ETHE that it posted as collateral, right? Here's where it gets kind of wonky. Once the BTC and ETHE is sent to 3AC via the collateral provided from the GBTC, that is sent back to Genesis, who acts as the authorized participant and submits the order to create shares of Grayscale Bitcoin and Grayscale Ethereum to the independent entity that is called Grayscale, and then 3AC receives the shares on the back end, right? So if we just take this end to end, retail users deposit funds into Earn. Gemini, which has made the statement multiple times over that it is not an investor, it's just the agent acting on behalf of the earned customer, who is the lender in this scenario, sends the money to Genesis less the fee it collects. Genesis then bundles that deposit, which is Bitcoin and Ethereum, deploys it to hedge funds like 3AC. 3AC posts collateral of the collateral 3AC posts to cover the loan is actually shares of the Grayscale Trust. So now Genesis has shares of the Grayscale Trust, which is again controlled by its parent organization DCG. 3AC sends back to Genesis the Bitcoin that it loaned to it. Genesis then submits the order to create the shares of GBTC and or ETHE using the deposited Bitcoin and or Ethereum, and then 3AC receives it on the back end. And what we claimed is that Ponzi might be an overstatement, but keep in mind that the Genesis issued long-term debt to 3 Arrows Capital against short-term positions from Gemini, right? So the money that Genesis received was depositor funds. These are liquid assets that can be recalled at any time, right? But the problem is that Genesis issued long-term loans using short-term assets. So when all of the depositors of the short-term assets want their money back, this is the bank run, right? And Genesis was only able to keep this merry-go-round going between 3AC and Grayscale because there were multiple depositors deploying capital into Genesis. But once the merry-go-round ended, Gemini's earned customers were the ones left holding the bag. It's quite unfortunate. If you want to learn more, wrote a very deep article about this that you can reference in the show notes, or just go to frontrunnercrypto.com and check it out there. So let's dive into the Grayscale box specifically, okay? Recall that Grayscale is a private investment vehicle that was formed in 2013 to grant institutional and accredited investors access to shares of Bitcoin and then later Ethereum without having to maintain your private keys, right? So investors send US dollar to the Grayscale Trust, the Grayscale's custodian, which is a separate entity outside of Grayscale, would take custody of the Bitcoin within the trust that was obtained via the US dollars deposited by the investors. A custodian just means they have the private keys, right, of the wallet. And then as an IOU, the investors would receive shares of the trust. In this case, it was GBTC and ETHE, right? So investors had exposure to digital assets in like 2013, 2014 without having to actually own the Bitcoin and Ethereum, which back in the day was super hard to do. I mean, it was a pain in the neck to like take custody of your assets. Most people left it on centralized exchanges like Mt. Gox. I know I certainly did, and then they lost it, right? So the name of the game was Grayscale gave retail investors the opportunity to buy Bitcoin and Ethereum within their traditional brokerage accounts. That was it, right? And as we stated earlier, the trust issued shares to its stockholders for deposits of cash or Bitcoin, right? And whenever the investor or stockholder of GBTC and ETHE wanted their Bitcoin and or Ethereum back, they could just redeem the shares. So when capital goes into the Grayscale Trust, that's creating shares of GBTC and ETHE. And then when investors request capital out of the Grayscale Trust, they're redeeming shares of GBTC and ETHE, right? And back in the day, you could do that because one of the original investment objectives of the trust was, and I'm highlighting this, to reflect the performance of the market price of Bitcoin. It's very important. People wanted to buy Bitcoin and Ethereum, and they wanted the IOU, or I mean, it's technically an IOU, but the stock of the Grayscale Trust to reflect the market price of Bitcoin, right? Remember, there's many more shares of the trust, and there are like Bitcoin and Ethereum tokens in existence. But if you were to divide the number of Bitcoin or Ethereum in possession divided by the number of shares outstanding in the trust, like that should equal the market price of Bitcoin and Ethereum. It's like 0.0001 like Bitcoin per share, 0.00001 Ethereum per share. It's one-to-one parity. But I noticed, so maybe starting December 2022, like two separate lawsuits were filed in 90 days. I'm gonna pull one out by two different shareholder groups. One is Fir Tree Capital Management. I think they have like $3 billion of assets under management, and the other is 210K Capital, which is an actual fund managed by UTXO Management, right? Both of them make the same claim that the trust has flagrantly disregarded its purpose and utterly failed to achieve its stated objectives, which is having the performance of the trust reflect the performance of the market price of Bitcoin, right? They go on to say, Fir Tree Partners says, in fact, the opposite has occurred. Grayscale, the trust sponsor, has prohibited investors from redeeming their shares, right? Off the back of this, the trust shares price has collapsed by 80% within the past year alone. The shares are now trading at a steep 40 to 45% discount to net asset value. This means that for every dollar Bitcoin owned by the trust, its corresponding shares are only worth 55 cents, which is something we've covered in great deal, right? So when I actually read the entire claim against Grayscale by both UTXO management and for venture partners, and like my question was, why would Grayscale intentionally abandon its investment goal? Why would any investment manager want to underperform their benchmark? It makes no sense. Like a fund manager of an S&P, of a fund manager whose fund performance is benchmarked to the S&P 500, like saying I'm going to intentionally underperform. It makes no sense, right? Investors would withdraw their capital and the fund would go to zero, and the guy would get fired, or the gal would get fired. The claim that for venture partners and UTXO cite is this really perverse conflict of interest within the parent organization DCG. And when you think about it, it kind of makes sense to me. I mean, at least the allegations of it do. So recall that Grayscale charges a 2% management fee. Like last year, this was maybe $700 million. That sucks already. But like what really sucks is how the management fee is calculated. Like it's based on the value of the Bitcoin held in the trust, not the market value of the trust shares. So I think there's 600,000 Bitcoins, right, in possession of the trust right now. 600,000 times, and what Bitcoin's at 25,000. So that's 600,000 times 25,000. That's 100, 300,000. Yeah, 15 billion. Damn, that's a lot. 15 billion. And then if the trust were charging 2% of that, yeah, 1, 2, 3. 1, 2, 3. Yeah, the trust gets $300 million in a management fee every year just from managing. That's such a crazy number. I just saying it out loud. There are $15 billion worth of Bitcoin in the Grayscale Bitcoin Trust. Grayscale charges a 2% management fee annualized, and that is equal to $300 million per year. Now, the members of the trust don't like that because the trust is not actually performing at the market price per share. So let's see if there were, let's do this again. If there were 600,000 Bitcoins, and each Bitcoin is $25,000, that's again like 15 billion, but it's trading at a discount of, let's just say, 50%. So that's really 7.5 billion, and then 2% of that. So yeah, $150 million. So because the trust is charging the management fee based on the value of the Bitcoin and not like the market value of the trust shares, which is trading at about a 50% discount to the net asset value. That's a swing of $150 million or $300 million a year. That's crazy. That's crazy. So because the way the trust makes money is not based on the performance of the share price, it's based on the quantity of Bitcoins and Ethereums held in the trust. It creates this weird incentive that the goal of Grayscale is not to maximize the share price of the Grayscale trust, but rather to hoard the number of Bitcoins and Ethereums in its possession, right? Then we can see in like the Grayscale S1, I highlighted that just to show this is real. This is from the S1 in 2013, right? It's calculated, the management fee to the sponsor, which is Grayscale, is calculated as 2% of the aggregate value of the trust shares, right? So when it's the aggregate value of the trust shares as of the end of 2022 was $300 million. But if it's the actual market price of each share, then it's under $50 million. So we go on. The investors who are suing Grayscale say that this creates an incentive for the trust to increase the number of investors, hoard the Bitcoin, and restrict redemptions, right? Because if the trust is one way in, your goal is to get as many people to deposit Bitcoins and Ethereums as possible, because once it's in, it can't get out. And that we'll cover this later on, but that might play into the angle with Grayscale making a big push to convert, or at least claiming to make a big push with respect to marketing to convert the trust into an ETF on the backdrop that it would yield an immediate like 90% ROI, right? So that is also a cause to deploy more Bitcoin and ETH, or at least buy more shares. So when I was like thinking through this out loud, my gut reaction is, all right, if this is true, if the sponsor of the trust, which is Grayscale, is intentionally trying to deceive potential investors by not acting in accordance with the fund's original objective, which is to maintain the market price of Bitcoin and Ethereum. Like, why would anybody invest, right? And there's two investor classes we have to cover. So the first one is retail investors. I try to answer the question, what would compel a retail investor to deploy their dollars, because they're buying secondary shares of the trust, into an investment product that has a 2% management fee that's based on the net asset value with a fluctuating market price that has historically traded at a premium or a discount, like it's never traded at spot, like Grayscale Trust. I mean, we can look this up now. I'm going to see this really quick. The same is true for Ethereum. You can look at performance. You can see as long as the trust has been like publicly traded, it's always traded at a premium to the holdings per share or the market price per share. So this is at a discount. It starts being at a discount at January 2021. So you can see when the market price per share is greater than the Bitcoin holdings per share, that's at a premium. When the market price per share is at a discount is less than the Bitcoin holdings or Ethereum holdings per share, then that's a discount. So why would an investor do that, right? If you could probably surmise why, but humor me for a second. And then on the institutional side, what would compel an institutional investor to deploy Bitcoin and ETH into a one-way trust that suspended redemptions and has stated multiple times that would only resume redemptions if approved by the SEC, which the SEC has denied 13 prior times? I think this might be the more important question, because if institutional investors don't deploy Bitcoin or Ethereum into the trust, then there is no trust. There can be no trust without institutional investors. It's called private placement, doing private placement investments into the Grayscale Trust. So what would be the catalyst to have an investor take so much risk, put their Bitcoin, put their Ethereum into a one-way trust, where the trust sponsor, Grayscale, has said, you're never going to get it out unless the SEC approves it. And by the way, the SEC has denied 13 other requests, right? Is it greed? I originally stated the answer was greed, but then I crossed it out and said it's actually a capital appreciation. And I wrote about this in an article that I'll paste in the show notes, but the reason retail investors deployed US dollars into the Grayscale Trust by purchasing secondary shares on the market is prior to 2021, they thought that BTC would appreciate in value at a higher rate than other equities in the brokerage account. Remember, if you wanted to buy Bitcoin and Ethereum in your brokerage account, the Grayscale was the only way to do it. It's the only way to do it. So maybe individuals who wanted 1 or 2% exposure would be forced to deploy capital into Grayscale via Fidelity, right? That was true up until 2021 when we had the less crypto winter and Grayscale started trading at a discount. So then the thesis traded in 2020. The thesis changed in 2021 where retail investors could buy GBTC and ETHE at a discount, right? Which is what we're seeing right now. And once the trust converts to an ETF, the holdings per share and the market price per share would converge to spot parity, and you would have like 80% return as of 126, right? And again, that's like an artificial constraint set forth by like government regulators. It has nothing to do with the performance of the Bitcoin and Ethereum trust. On that investment thesis, you're not even betting that the value of Bitcoin is going to go up or the value of Ethereum is going to go up. What you're betting on is that the market price per share of Grayscale will converge with the Bitcoin and Ethereum holdings per share, which can only happen uh, if there's an ETF conversion. And like in plain English, it means if the market price per share of Grayscale is $12, but based on its net asset value, it should be $20 when the ETF conversion is approved. That means the share would immediately go up to $20, like overnight, instantly, right? So that's like my assessment as to why retail investors would, you know, roll the dice and take such a risky position on GBTC and ETHE. And hell, I did it too, and I still stand by that. I think it's a great trade, even on the backdrop of all this uncertainty. Institutional investors, on the other hand, were deploying BTC. Institutional investors were deploying BTC and Ethereum into Grayscale. Make a note of this because retail buyers are willing to pay a premium to own Bitcoin and Ethereum. Like that's why. So what would happen was institutional investors deploy, would deposit Bitcoin and Ethereum into the Grayscale Trust via the private placement opportunities, and then receive shares of GBTC, ETHE in return. There was a 6-month lockup period though, where they couldn't sell it. But since the shares are trading at like 40 to 50% of the underlying assets value at a premium, they would just sell their positions 6 months later to retail investors in part one. And it was a great trade, and that's actually that's what 3AC did. And when you see in 2020, 2021, 300,000 shares of Bitcoin were deposited, it was all because of that. They're like investors were trying to capitalize on that premium. But what we end up realizing, and hindsight's 2020, is that it doesn't matter what side of the trade you were on, whether you're a retail investor sending USD to get GBTC on the secondary market, or whether you're an institutional investor sending BTC to receive GBTC or ETHE that you have to hold for 6 months before selling it. Grayscale was making money on every trade, right? Grayscale collected a 2% management fee from the retail side, and Grayscale collected the 2% management fee from the institutional investor side. So that's why. Now, the fund starts to underperform. And again, underperformance in the context of the trust is where the holdings per share is greater than the market price per share. That means if Bitcoin is trading at, if you were to divide the number of Bitcoins held in the trust possession and divide it by the number of trust shares, as of like November 2021, you would get like $61 a share. So you would expect the share price to be $61, but it actually wasn't. Like on November 2021, the share price was $52, right? That's because it was trading at a discount. If all the investors were really upset about this scenario, like trading at a discount, why wouldn't they just withdraw their Bitcoin and Ethereum they deposited, right? This is called redeeming the trust shares for the underlying asset. And if you think about this, if there is a sustained reduction of assets under management, that would force Grayscale to like reevaluate its management fee structures, and also reducing the quantity of digital assets in possession of the trust would also increase the spot price or market price of the trust shares. I call this forcing parity. Okay, why did this happen? It didn't happen because it couldn't happen. And here's where like all the lawsuits start to get kind of dicey, and they might have some merit if you think about it. And let's walk through this together to understand why. So remember, Grayscale said trust shares cannot be redeemed for their underlying asset because of regulatory constraints related to Regulation M. Regulation M is a ruling within the SEC that facilitates asset conversion to an ETF, right? So the only way Grayscale can ensure that the trust holdings per share is equal to the market price per share is if the trust is converted to an ETF, and one of the steps in that trust is Regulation M requirement. I wrote an article about Regulation M in great detail. I'll put in the show notes for those who want to review. Right, so because of this regulatory constraint, depositors of ETH and Bitcoin to the trust were not able to withdraw their assets, hence the one way in, no way out. But we've always operated under the assumption that Grayscale is acting in good faith to actually move towards an ETF conversion. Remember, last year they sued the SEC and have stated in multiple times across multiple Grayscale newsletters that, and I'm quoting, Grayscale is unequivocally committed to converting GBTC, ETHE to an ETF. We have left no stone unturned. We have leveraged the full resources of the firm behind this effort. And in true Grayscale fashion, we will operate in the best interest of our investors. That is the June 2022 Grayscale Investor Newsletter. So, the question I have to the listeners and viewers is, what if the inability to redeem Grayscale shares for its underlying asset was not a byproduct of regulatory oversight, but it was rather intentional restrictions on stockholder redemptions created by Grayscale purposefully to maximize management fees? Okay, so let's unpack that a little bit by reviewing the history of Grayscale. So we went through a bunch of SEC filings, regulatory filings, legal documents, and the net of all of that is Grayscale's trust agreements and restated declarations, which are just modifications to the agreements of the trust after they've been published. It's a lot of legalese, but it's pretty simple once you like think about it. So in 2013, Grayscale launched the trust, right? It was a private investment vehicle. It was not available to retail traders. There was no like GBTC, ETHE share that you could like buy on your Fidelity account. It was the Wild West. 2013 was like back in the Mt. Gox days. So in 2014, but recall in 2013, you investors were able to redeem their Bitcoin. So I could deposit uh, $100 into the Grayscale Trust and receive Grayscale shares worth $100 of Bitcoin. And then I could redeem the $100 of the Grayscale Trust shares for $100 of Bitcoin or $100 of US dollar. That's called redemption, right? The opposite is creation. In 2014, Grayscale suspended the redemption program, citing the Regulation M ruling that we talked about, but it granted existing stockholders redemption rights. So new stockholders into the Grayscale Trust weren't able to. They were able to create shares, but not redeem shares. But existing stockholders had redemption rights. So in 2015, Grayscale became a publicly traded fund, which is what you now know as the GBTC THE Grayscale Trust that you can go to Fidelity, E-Trade, and buy. Right. 2016, the trust declarations are amended to essentially distribute Bitcoin upon redemption units, which is just a fancy way of saying they can redeem trust shares again for its underlying asset. And here's what I found interesting is that any future amendments or restatements to the trust could only occur upon written consent of at least 50% of the stockholders. So this is implying that if the trust wanted to restrict redemption rights, change the trust sponsor, change the management fee, so on and so forth, it would require at least 50% of the voter approval. But what else happened that year? In 2016, Grayscale settles with the SEC. In 2016, the SEC actually launched a cease and desist claim against Grayscale for violating Regulation M. And it's kind of funny to like go through it. Back then it was called Second Market. But the TLDR is that Bit, which was the token before GBTC, agreed to cease and desist from causing any violations related to Regulation M of the Exchange Act, and then agreed to pay a whopping $53,000 fine. Can you believe that $53,000 is all they had to pay? And now the Grayscale Trust has $15 billion of assets under management, charges $300 million in management fees per year. It's wild. So 2017, off the backdrop of the 2016 lawsuit, Grayscale completely eliminated the redemption rights and removed the ability for stockholders to remove the sponsor, which again is Grayscale, except for very specific events. So what's wild is that this was like a 2-for-1. Grayscale says, all right, stockholders, no longer can you redeem your shares for the underlying asset, which is now like the one-way deposit we keep describing. But you also can't remove us as your sponsor. And we're still going to charge you a 2% management fee. And they didn't even do this with like shareholder approval of at least 50%. It was wild. So Grayscale makes these amendments, doesn't do the requisite 50% voting requirement, completely eliminates redemption rights, and then by 2018, Grayscale doubles down on the elimination of redemption rights by saying that we're going to restrict all stockholder redemptions unless the sponsor receives, it's called the receipt of regulatory approval, but it's just the SEC granting Regulation M relief and saying that by redeeming shares of GBTC and ETHE for an underlying asset, Grayscale is not in violation of, the regulation and requirements that were fined for in 2016. And I mean, come on, man, 2016, they paid $52,000. Compare that to the $300 million of assets under the $300 million management fee they're able to collect every year. It's wild. So now by 2019, just remember, Grayscale suspended its redemption program and they paid the fine, $50,000, right? What was kind of like damning, and we saw this in their 10K, is that Grayscale, and I'm quoting this, stated that it's not seeking SEC regulatory approval because the trust does not believe that the SEC would at this time entertain an application for the waiver of rules needed to operate an ongoing redemption program. Moreover, the trust currently has no intention of seeking regulatory approval from the SEC. So the Grayscale is saying at this point, you can't redeem your shares of Grayscale and Ethereum Bitcoin for real Bitcoin or Ethereum unless the SEC tells us. And the only way the SEC is going to tell us is if we apply, but we're not going to apply because we don't think we're going to get approved. Isn't that wild? It's like you're going to fail, so don't even try. By the way, keep paying our management fee. So by 2020, there was quite a bit of uncertainty with respect to the aggregate stockholder population. They were contesting the hypocrisy in Grayscale's position to revoke redemption rights, really on two basis points. The lawsuit contends that regulation and compliance only mandates that the creation and redemption of shares can't be performed simultaneously. This is what an ETF does. Shares go in, gets converted to a basket of shares in an ETF. The ETF shares appear in the open market, and they can be sold to the general population, right? The same process works the other way. When shares are sold, right, the basket of underlying assets in the shares are redeemed, and the ETF holder gets their money back. The investors are saying Regulation M is only violated if the creation and redemption functions happen at the same time. Just don't do the creation and redemption at the same time, Grayscale, and you'll be okay. That's part one. But part two is the shareholders the Grayscale shareholders are also claiming that, hey, Grayscale, you've never actually submitted an application for a waiver, so what the hell? How could you say that the trust is unable to grant redemption rights if you've never even applied? So that's 2020. So how does Grayscale respond to those claims? In complete agreement. By 2022, Grayscale has eliminated all the language in their 10K citing the belief that the SEC would deny approval for the redemption program, right? So in 10Ks prior to 2022, Grayscale would say, hey, sorry, investor, we can't perform this redemption because SEC won't let us. By 2022, Grayscale removes it completely. I mean, and I'll just read a quote from I pulled up their 2022 10K. Note that the language now says, subject to receipt of regulatory approval from the SEC and approval by the sponsor and sole discretion, the trust may in the future operate a redemption program. That is a dramatic change in language from their 2018 language, their 2018 SEC that says, the trust does not believe that the SEC would at this time entertain an application for the waiver of rules needed to operate an ongoing redemption program, so we have no intention of seeking regulatory approval. And just think about like the backdrop of funds. under management from 2018 to 2022. Remember, in 2018, the trust had about $750 million of assets under management, which yielded maybe $28 million of management fees. By 2022, the AUM grew to $30 billion, which is $600 million in management fees. That's an increase of 2,000%. A 67% increase for the period reported in 2021 over 2020. So that's the claim, at least from part one of the lawsuit, that the Grayscale Trust isn't operating isn't advocating for its stockholders because it is intentionally failing to ensure the holdings per share price is equal to the market price per share. But Grayscale then says, and I think everybody knew or should probably remember this, right? There's an ETF conversion. What about the ETF? The entire premise of Grayscale converting to an ETF was that it would force spot parity on the market price per share as well as the asset price per share. So it kind of doesn't make any sense. Like, why would Grayscale intentionally underperform on its one goal of ensuring parity between the asset price per share and the market price per share, and then on the other hand, also sue the SEC to try to bring the market price per share and the asset price per share into parity? This is where it gets really wild. Virtue Ventures is saying that this whole like ETF conversion is just a facade, right? It's a exploitative and wasteful campaign destined to drag out in the courts for years. An elaborate marketing expense to lure retail investors into the trust with no way out. And my immediate gut reaction was like, how is this possible? And the claim they make is the purpose of the trust has morphed over time. In 2013, when Grayscale started, the founder stated that the trust was only suitable for accredited investors. And I found like a deal book article from way back when that says, because of the risky, I'm quoting, because of the risky nature of Bitcoins, they should not be sold to ordinary retail investors who could buy ETFs. It's premature for this kind of product to be in the public market. It should not be available to unsophisticated investors. This was in 2013. And compare that with 2022, where now Grayscale is saying that, oh, wow, everyone should own Bitcoin, and they can do that with an ETF, right? So what happened? From 2013 to like maybe 2016, Grayscale stayed true to this vision that Bitcoin and Ethereum should only be available to accredited investors. But in 2016, I posted a tweet on this. They launched their Drop Gold campaign to attract retail investors, implying that holding gold in their portfolios was stuck in the past. And I did some math, and you can check on frontrunjohn.com or my Twitter account, frontrunjohn, that $1 invested in 2016, if you put that in Bitcoin, it's $39 today. If you put that in Ethereum, it's $1,249 today. And gold ETF, it's only $2, right? So what happened? 2013, Grayscale says, no, accredited investors only. 2016, they start to, maybe change their attitude. And then by 2021, when Grayscale has a new CEO, which is the 34-year-old Michael Soshinen, his first mandate in a company newsletter was to convert the Grayscale into an ETF, right? From the 2021 newsletter, with the new CEO of Grayscale, each Grayscale product is at various stages of this life cycle, and our intention has always been to, quote, convert these products into an ETF. But from the 2013 quote, literally the founder of Grayscale is saying, ordinary They're saying due to the risky nature of Bitcoins, they should not be sold to ordinary retail investors who could buy ETFs. Literal 180 from the founder's vision, right? So how does like Grayscale begin to like manifest this change in attitude? And if you've been around a couple seasons, there's like a couple, I think, super apparent ways that Grayscale is trying to push the ETF dialogue onto retail investors. Remember, there was the How Dad Got into Bitcoin ad. There was making Grayscale, making crypto accessible to the masses. Grayscale in your 401k. There were templated letters that Grayscale issued about how you can show your support with Grayscale and the SEC. There were email reminders about submitting comments to the SEC. There was even advertising that pushed for converting the trust into an ETF. And I think this is in Washington, D.C., Penn Station. I have an ad that says, we took over all the ads in the station because we care about crypto investors, right? The SEC wants to hear from investors like you. Scan the QR code to advocate for a Bitcoin ETF. Wasn't this the exact opposite of what the founder's vision was in 2013, stating that Bitcoin is not suitable for retail investors via an ETF? Wild, right? So then there's that backdrop that the plaintiffs suing Grayscale and DCG make. Like, number one, you are not actually advocating in the interest of the shareholders as reflected by the divergence in the market price per share versus the asset price per share. You have the one way in, no way out constraint that they believe to be self-imposed, not a byproduct of actual regulation and requirements. And then number two, this ETF conversion marketing campaign is just a ploy to get more retail traders to buy shares of the Grayscale and Ethereum trusts which will hopefully increase the actual price per share. There's no actual meat behind the ETF conversion, right? If through these advertisements, the claim is that Grayscale is attracting retail investors to buy shares of the trust, in that when the trust is approved for ETF conversion, the holdings per share and the market price per share would converge on one, which you can see like the spread's as wide as 50% at sometimes. So that's great. That's Grayscale, but like we haven't really talked about like digital currency group, and this is where the third piece of the puzzle really starts to unfold, right? Part one is the intentional misalignment of investor interest. Part two is the failed marketing campaign. And part three is the lack of independent oversight. So what we found is that Grayscale and DCG share the same CEO. Grayscale and DCG share the same audit committee. And Grayscale, within the DCG audit committee, that's also the Grayscale audit committee. Its members are the CEO, CEO, and CFO. So it's literally the people. And for those who don't know, the audit committee is like the governing body responsible for financial reporting of the organization. So like literally the people responsible for the financial health of Grayscale, it's the CEO, COO, and CFO of DCG. I guess even worse because like Grayscale actually acknowledges that there's no formal procedure to resolve conflicts of interest, but rather to rely on Grayscale's management team, which is the same management team of DCG. And like here's the quote from their 2021 10K. The sponsor has not established formal procedures to resolve all potential conflicts of interest. Consequently, shareholders may be dependent on the good faith of the respective parties, subject to conflicts to resolve them equitably. The sponsor attempts to monitor these conflicts, but it is extremely difficult, if not impossible for the sponsor to ensure these conflicts do not, in fact, result in adverse consequences of the trust. They're saying, hey, we're the CEO of DCG, COO of DCG, CFO of DCG, which, by the way, owns Grayscale, and we're also on the audit committee of Grayscale. There's no like independent governance board, independent entity ensuring that Grayscale acts in the best interest of Grayscale and not necessarily in DCG. And what you can see now is, given that the DCG management team is also on the audit committee of Grayscale, perhaps the decision to eliminate redemption rights on the basis of Regulation M might be a byproduct of maximizing the trust management fee, which goes directly to DCG, as opposed to ensuring the market price of the trust is actually equal to the assets price per share. And that's the third part, but the fourth part is now like the reliance of, we call it affiliated service providers within the DCG corporate entity. So it's already bad enough that Grayscale and DCG share the same like governance oversight board, the audit committee, but in order for Grayscale to create and redeem shares and to price the actual asset of Bitcoin and Ethereum, it has to be done through other subsidiaries within DCG. So Genesis is the only subsidiary. Genesis is the only entity that could create and redeem Grayscale shares. Grayscale uses the CoinDex index to calculate the price of the trust. Grayscale relies on Coinbase to custody its holdings. And remember, Coinbase, DCG is a minority owner of Coinbase. So you put it all together, Grayscale is at the bottom, DCG is at the top. Grayscale relies on Genesis in the middle to create and redeem Grayscale shares. Grayscale relies on CoinDesk to calculate the price of the trust index, which is owned by DCG at the top. And Grayscale relies on Coinbase to custody all of the assets, which DCG is a minority owner in. It's kind of crazy, right? So, given these claims, how does the audit committee, which again is the CEO, CFO, and COO of DCG, how does the audit committee of Grayscale respond? Generally in complete agreement. We pulled up their most recent 10K, and they've essentially stated that, and I'm quoting, the audit committee has the responsibility for overseeing the financial reporting of the trust, including the risk and controls of the process and such other oversight functions that are typically performed by an audit member of a public company, right? So in a public company, the audit committee is not the CEO, it's not the CFO, it's an independent. At a minimum, it contains other members not affiliated with the parent organization to ensure some sense of like independent decision making or independent governance body. But they go on to say in the 10K that the audit committee consists of Silbert, Sonnenschein, and McGee, all board members of DCG. It's pretty wild. So to put this all together, there's really four pillars. Number one, the claim is that Grayscale is completely beholden to the DCG management team. Grayscale is intentionally slow-walking deregulation and conversion under a self-imposed set of constraints. Number three, Grayscale is attempting to maximize both institutional and retail investor inflows at the expense of its trust goals, which is, market price parity with the asset price. And Grayscale is orchestrating an elaborate marketing campaign to increase inflows on the pretense of an ETF conversion that will never happen. So all those ads you see in Penn Station, it's just drop gold. It's just a facade to get people to deposit, to buy shares of Grayscale Trust, on the hopes that an ETF conversion will happen. That will never ever happen because the SEC has denied all the 13 claims, right? The question, like, I'd want to know is, like, is any of this working? Like, is the number of Bitcoins in possession of Grayscale going up? Is the share price of Grayscale going up? Is the spread going down? Right? If more people are depositing ETH and Bitcoin into the trust, that could be one way. And on the other side, more people are buying shares of the trust. It converges at parity. So when I reviewed the Grayscale annual reports from 2019 to 2022, what I concluded is that all this is wild. Let me zoom in. 50% of the trust growth came in 2020. So 635 Bitcoins were in possession of the trust as of the end of 2022. 353,000 were acquired in 2020, right? That is almost 50%. But when you look at 2020 to 2021, the fund contribution declines by 85%. In 2020, 353,000 Bitcoins were deposited. In 2021, 50,000 were deposited. In 2022, 0 were deposited. Why? So why did this happen? Well, 2021 was the year that the trust began to trade at a discount to its native asset value, right? So the reason investors were deploying BTC and BTC and ETH into the trust, holding it for 6 months, selling it on the open market to capture the premium, that premium was disappearing. In addition to that, the rolling 6-month lockup period of shares becoming tradable ended on January 2021. So that means all of the shares bought 6 months prior that couldn't be sold now can be sold. So now you have a double whammy where the premium begins to trade at a discount and a new batch of shares are unlocking. And the net result is that institutional holders of the Grayscale Bitcoin and Ethereum Trust now start dumping their position onto retail traders, which only further decreases the actual market price per share of the trust, but also increases the discount to its net asset value premium, or sorry, spread. So let me repeat that again. Institutional investors are selling shares of the trust on the open market to capture the premium trade while it's still there. Many shares are getting sold. There's also the crypto winter that we've talked about in the past. This is in 2021. Put all that together, the trust starts to trade at a discount, which causes the trust shares to decrease, which causes the spread of the market price per share and the asset value per share to increase. And what you have is somewhere nearly 50% discount to its asset value, right? The net result, institutional traders are selling their newly unlocked and still profitable shares of GBTC on the open market to retail bag holders. They were doing this at such a clip that Grayscale had to suspend its private placement contributions in 2022. I actually went to Grayscale recently and tried to create a private placement account, see if I could buy some shares of GBTC and ETHE by depositing BTC and ETH, right? And Grayscale halted the private placement contributions in 2022 to backstop the widening discount to its net asset value. If you think about it, more Bitcoin than Ethereum is coming to the trust shares are going down. That increases the spread between the market price per share and the asset price per share, and it's a double whammy. No one's buying and more assets are inflowing. The net result is, at least what the plaintiffs are claiming, is that Grayscale halted all contributions in an effort to backstop the price of the trust shares in the public market. And that's why you see in 2022, there are only 635,000 Bitcoins in possession of the trust, which is a decrease of 644,000 from 2021. And it will keep going down every year. It will keep going down every year until the trust enables private placement. So I put this all together, and we can conclude that although the net asset value discount spread has closed by 15% from its value of 48% to 41%, and the Grayscale Bitcoin Trust has seen an increase of 51% from its 780 per share low to its current price of 1236 that I predicted would happen, and I wrote about it, and it's in the show notes. I'm willing to at least attribute a small amount of this gain to the Grayscale marketing that's been enforced over the past year, as well as the suspension of new deposits. But I would for sure to continue to proceed with caution. I think if you have any position in the Grayscale Trust, I encourage you to visit redeemgptc.com because it has a lot of information on the lawsuit that's unfolding. With that said, that concludes today's episode. Putting it all together, the super speed run is Grayscale has no independence oversight board. It's beholden to DCG. Grayscale is intentionally slow-walking regulation and ETF conversion. Grayscale is attempting to maximize inbound flows at the expense of institutional investors and retail traders. And Grayscale's marketing campaign to convert to an ETF conversion is one big facade. Given that I own shares of GBTC, what I'm actually confident in is that the assets are there, and whether it's by appointing a new sponsor or through SEC litigation, there will be a day when the trust shares are redeemable for its underlying asset, and when that happens, it will be a net windfall of 80 to 150%. So you got to put the long game in this, but that wraps it up for the day. If you want to know why, I put in the show notes. Stay tuned in part 3. We'll tie this all together. Part 1 was talking about Gemini and Genesis. Part 2, we talked about Grayscale. In part 3, we're going to tie the Grayscale accountability, the DCG conflict of interest, Genesis bankruptcy, the Gemini and 3AC implicit support model. We're going to tie it all together in a masterclass of corporate fraud. This is the kind of stuff that they taught you when you're getting an MBA. I mean, or it could be a really good movie, one or the other. But until then, I'm your host, John Cook. Thank you for listening. Remember, we are on a journey to front run the next generation of wealth creation that we believe is decentralized finance and crypto. If you like this analysis, you want to learn more, maybe you didn't like it, hit the subscribe button, leave a comment, share with your friends, and subscribe to our free newsletter at frontrunnercrypto.com. And remember, don't invest more than you're willing to lose, because you could lose it all. You could lose it all for sure. So until next time, guys, peace.